So, ladies and gentlemen, dear friends of BRS, I wish you all a warm welcome to this 5th edition of the Microfinance Lunch Break. For ADA, our Luxembourg partner, represented here today by its chairman, Mr. Robert Wagner, and by Mr. Axel de Ville, with 18 sessions gone, the Midi de la Microfinance in Luxembourg already has a long tradition. But with this 5th edition here in Brussels, these microfinance lunch breaks also are becoming a landmark in the Belgian financial and economical circles. The aim of the microfinance lunch breaks is to raise the awareness and to increase the interest for the challenging world of microfinance and microinsurance. Today, we go already through the 5th edition, and as a lot of you can state, there is an increasing interest for the subject. And as promised earlier, we will try and alternate the subject between microfinance and microinsurance. BRS is convinced that with ADA, Febelfin, Assuralia, KBC, our host here today, and Cera, it has strong partners who are convinced of the important role microfinance and microinsurance plays and has to play in the future, and are willing to support this initiative very actively. We kicked off the first edition in February 2009 with Damien van Stauffenberg from Microrate, who dealt with the issue of the impact of the financial crisis on microfinance. It's 2 years ago, but even today, these themes remain a topic of the moment. We went on with Eric Ecoué with regulation in the microfinance sector, followed with the first theme on microinsurance by Craig Churchill, innovating risk coping mechanisms. The previous edition, in February 2011, was a direct hit. Jonathan Murdoch took us along for a journey in the world of the poor. He gave us an interesting view inside the portfolios of the poor, how the world's poor live on $2 a day. And so, we are here again today with the daring subject entitled Investments and Subsidies, Matching the Funding of Microfinance? ? We might also ask, should we continue to fund microfinance at all? During the last 5 years, large amounts of funding flew into the microfinance sector with obvious positive effects. A tremendous growth of the sector, financially and socially well-performing MFIs throughout the world, access to sophisticated products and services for a significant number of individuals formerly excluded from the financial system. Also, evolving standards in terms of impact, performance, and regulation. Over the last 2 years, however, microfinance has to some extent been a victim of its own success. There were several drawbacks and much criticism. Is this the result of inappropriate or too much funding? Is there a link between too much funding and the bad microfinance practices that have emerged recently, like for example in India? Is there an imbalance between the amount of investments and donor funding within the sector that exacerbates the problem? And how can investments and donor funding play a better role in strengthening the sector? A lot of challenges to be addressed by our honored speaker of today, Professor Malcolm Harper. Mr. Harper was educated at Oxford, Harvard, and Nairobi, and is Emeritus Professor of Enterprise Development at the Cranfield School of Management. He was and is involved in various projects related to microenterprises and financial inclusion. And he was also chair of the microfinance institution Basics Finance in India until 2006. Mr. Harper is co-editor of some critical publications, such as What's Wrong with Microfinance? Our previous speaker, Mr. Jonathan Murdoch, wrote about this book, and I quote, "This book unapologetically asks questions that others have been too polite, complacent, or uncritical to ask. You don't have to agree with everything, or even most of it, to learn a great deal." So, ladies and gentlemen, we have a daring subject, and I may assume a slightly provocative speaker. Professor Harper will now share his field experience with practical examples while focusing on the impact on the populations whom are served by microfinance. Together with you, I'm looking forward to a challenging and fascinating discussion about this matter. Mr. Harper, the floor is yours.
Thank you, sir, very much, and thank you all for inviting me here. And I see reasonable numbers in this vast hall. I don't know whether the numbers are to do with the lack of alternative entertainments on Friday, or a wish to flee from the reality of the financial world in which some of you work, to this thing that takes place in hot countries a long way away. But I hope that I can make a few provocative remarks. It's always been my habit as a teacher to not exactly perhaps to talk nonsense, but to try to make people think by stating perhaps slightly extreme views. And I'll perhaps do the same today. I should also preface my remarks by stressing that most of my experience is in India. As was just said, I was chair of a thing called Basics for 10 years. I stopped in 2006, not because they threw me out, although perhaps some of them wanted me to, but because I thought 10 years was enough. In some ways, I got out in time. As I say, much of what I'll say is based on my experience in India, which is the world's biggest market for microfinance because it is the world's poorest country by an enormous margin. Let me say again, as I said yesterday, the poor, the dirt poor, and they are living in dirt of India, outnumber the total population of sub-Saharan Africa. And although India is doing very well in some respects, there's about 500 million people who are not doing very well at all. And therefore, if microfinance can play any part in making them do a little bit less badly, then obviously India is the place which needs microfinance the most, and the world's biggest market for microfinance, and therefore what happens there, and some pretty dramatic things have been happening there, as was already pointed out in the last year or so, are both of enormous importance in themselves, but can also teach the rest of us quite a lot. Let me just start by posing this question, and it's interesting doing this in the context of an institution which I believe represents a marriage. I don't know anything about how happy the marriage is between commercial and cooperative banking. But being old and perhaps even slightly old-fashioned as well, it should perhaps be clear that my answer to the question that's posed there is very much the second option. That not only does or did financial intermediation start in Europe, in most places, with people, and still is starting in Africa and everywhere else, with people pooling their savings because they want to save, and they want to be able to withdraw their savings when they need them, and also they want to be able to borrow when they need to. And I'm sure Jonathan Murdoch will, those of you who are here, will have told you enough about the way in which poor people manage their money to make it clear that savings are a fundamental, indissoluble part of financial services, particularly for poor people who have little financial sophistication, little time to spend choosing between different financial institutions or going from one financial institution to another for different kinds of products. So perhaps the burden of my brief talk is adequately summed up by this slide. But let me now look at it from the point of view of the person running a microfinance institution in a poor country. I prefer the word poor, crude though it may be, to the word developing, which is nonsense, because many are not. But put yourself in the position of somebody who is managing a microfinance institution and needs to raise funds in order to finance the operations. Putting yourself in that position in some town or even some village in India or Africa, if you look Closest to home, if you look out of your own front door, if there is a door, you see the people in whose interest you have started the microfinance institution, namely poor people who want to borrow from you and who, contrary to perhaps what one might suppose, actually also want to save and desperately want to save. But it's quite difficult to get them to save with you, starting your new microfinance institution. They're going to give small amounts of money and so on, and they want to take the money out. So maybe, or in addition to thinking about their savings, you'll think of walking down the road or even going to the capital city to a local bank. And the local banker, and I've met with many of these people in Africa and India and so on, is actually not terribly inclined to mingle with socially, physically, nor are his customers interested in mingling physically with poorer people. And banking is for gentlemen and perhaps for ladies, but certainly not for the poor. I know two banks, actually, one in Zimbabwe and another one in India, where the customers actually complained when these banks tried to get into microfinance that they didn't like mingling with smelly poor people. So they had to open separate banking halls for them. So there are reasons why, if you're starting a microfinance institution or trying to grow one, that you don't want to get savings from the clients, nor do you want to, or will you enjoy, getting money from your local banker. But the alternative, which is cheaper and easier, is more fun, is to go and get a bulk loan from Brussels. There are now, I think, over 100 MIVs, microfinance investment vehicles, and of course there are banks which have either financed them or themselves financing microfinance, and there are also many individuals doing it direct. And instead of scraping around getting savings of 100 rupees and paying back 20 rupees and so on from clients themselves, or suffering the indignities of visiting the local banker who thinks you're talking nonsense, you can come to Brussels or to New York or London or even to Luxembourg, and you can get $10 million or whatever you need, and maybe he'll even pay your way. And what's more, more likely he, but sometimes she, who is actually giving you or lending you this money, is telling the people who've provided the finance, and this believes himself, that he's helping the poor, that he's doing well as doing good. He's achieving Prahalada's objective of the double bottom line. And when he hands you the check, you get a bit of a reflection of that warm glow. You too are helping the poor. Whereas the local banker isn't interested in that, and nor are the savers, because they are themselves poor. So it's a lot nicer, and it's also cheaper, because the transaction costs are very low indeed, and as I say, the lender may even pay your airfare, maybe even club class. So it's a nicer and a cheaper thing to do, to raise foreign money. And savings in particular are tough to get. In basics, we successfully got a banking license, and I'll talk about this in a moment a little more, for 3 of the districts in which we're operating. So after 4 years, we converted our non-bank finance company, which was operating there and just giving loans, which was all it was allowed to do. We were allowed to convert it into a bank. We found that raising savings from our customers was expensive, as banks had already known. It cost around 10% of every rupee that we raised to handle the money, the transaction costs, the physical cost of handling small sums of money, keeping the records, having cash available at the times and places when people wanted to withdraw it and so on. It was expensive even if we paid no interest at all, and we had to pay some interest. Of course, we were competing with informal savings mechanisms which paid no interest at all on savings, or even charged people for the privilege of saving with them. And that was quite difficult, because the service they operated, door-to-door savings collection and so on, was very difficult to rival. So savings were expensive to get, even if we didn't pay interest on them. We also had to, as we did get, a banking license, but that was difficult. It took 4 years to get it. And the bureaucratic requirements of reporting to the central bank, holding adequate capital and so on, were obviously onerous. It was a very different kind of institution that was required to a pure indebting institution, which is what microcredit is. And of course, we couldn't be sure when we were going to get savings in or when we were going to have to pay them out. And therefore, it was far more difficult to do the treasury management than if you're taking one bulk loan from a foreign or local institution with a known repayment schedule. And there was a cultural change in that our customers, who had up to then been, okay, we did start, like most MFIs, as an NGO, had been in some sense suppliants. We were the nice guys with the money, and they were the poor people who, please, can we have some? And even though it was a loan which had to be repaid and what interest was charged, nevertheless, they came in some sense as suppliants. And I suspect even here in Brussels today, somebody who wants to raise a loan, still there is some element of the suppliant relationship, particularly at the consumer level, where you go and ask for a loan, and you have to put on your best tie in order to do so. That kind of suppliant relationship tends to disappear when the same person is also entrusting you with his or her money. So the organizational relationship, the client-staff relationship, changes very much when your clients are the people who are not only borrowing from you, but also saving with you. And that's very uncomfortable. It took us about 10 years to make that change. After 4 years of being a credit-only institution, it's right now, I guess it's fully recognized as a bank, but it took a long time to change that view. So it's easier to come to Brussels. But what is easiest is not always the best thing to do. Because, as I'm sure Jonathan will have told you, those of you who are here, decent savings facilities are what poor people, and indeed better off people like all of us in this room, need the most. I suppose everybody here has a bank account. I remember a long time ago, longer ago than I care to admit, my father took me to the local bank. And he introduced me to the cashier or even to some under manager, and it was all a bit of an occasion. I think I was about 11 or something. And I think I had saved maybe 10 shillings, and he may have done a matching grant, so I had the grand total of £1, and I opened my first bank account. And I vaguely remember the occasion, but I don't remember that anything was said about my getting a loan. I was going to save, and if I behaved myself and saved, I might be able to withdraw the money not to buy sweets, not even to buy a toy, but maybe to buy a book. And banking, as portrayed to me as a small boy, was a bank was a place where you saved your money. Later on, I came to realize it was also a place where you borrowed money. But fundamentally, it was savings first. Savings not just as a condition for getting a loan in 6 months' time, but savings as a good thing to do in its own right. And I don't think that's an entirely forgotten or outdated culture. The book that was referred to earlier, which Jonathan was so nice about, there was an interesting paper in it by my co-editor, Thomas Dichter, where he talks about the social meaning of debt. And I think in spite of what I see of my grandchildren who are now at university and student loans and so on, I think we still believe, don't we, that having savings is good and being in debt is not quite so good. I don't think even my cynical oldest grandson, who's now 20, says his aim in life is to have lots of debt. He wants to put other people into debt. Actually, he's foolish enough to want to go to the financial world. But savings are surely the initial purpose and the origin of sensible banking and are what people need. And when I walk around, as I frequently do, in villages in India, and I ask people how they save, the answers are sad, because the banks are not receptive. Although some of them are, on the whole they are not convenient, and the lengths to which people go and the risks people take in order to get money out of the house, out of perhaps the hands of their husbands, and into a safe place, never mind a remunerative place, Most typical savings collectors in India take 1 day a month money for themselves. So if you save 10 euros a day, then the savings collector will take 1 day's collections every month as the fee for taking your savings, a fairly high negative rate of interest he's paying you. That's a typical savings mechanism. So people need safe, accessible savings products more than they need microcredit, or as David Hume, my friend at Manchester University, called it 15 years ago and sadly was largely ignored, microdebt. Because the function of most microfinance institutions still is to put people into debt. And okay, that's not necessarily a bad thing, but that's the main thing they do. And foreign money, I would argue, contributes to that being easier, to that being the thing that they mostly do, and contributes to them doing too much of it. Apart from crowding out local savings, for making it, as it made us in basics, less necessary to beat on the door of the central bank in order to get banking licenses in other than the 3 districts where we got them, we didn't really need it because we had enough money from you kind fellows who are willing to lend it to us or invest it in us. So what were the other effects of what happened to basics and happened to other institutions in India, and I see it happening elsewhere, of having, in a sense, a queue of people trying to invest in us and trying to lend money to us? Well, it happened to basics, it happened to others far worse. Basics has survived, I'm not sure some of the others will. We lent to everybody. Never mind the fact that it already got 2 or 3 other loans because we were marketing an attractive product, and so we overlent to people who were already in debt to other institutions. The competition was to lend, not to improve our services. Staff, and I speak not of basics actually as much as other institutions, incentives were very much based on the number of loans they made, most importantly on the amount of loans they made. Pushing out the money, moving the money, which is a phrase I heard first in the World Bank with other larger sums, but I hear it in branches of microfinance institutions in India as well. Moving the money, getting the money out the door. That became the driving purpose, pushed in major part by foreign money coming in, which we had to lend to the poor. Other services tend to be neglected, whether it be training or other varieties of finance or other things that people need, even insurance, tended to be neglected because the aim was and still is so often to push the money out the door, indeed to indebt our clients. And of course, savings mobilization is neglected. Smaller borrowers, particularly new borrowers, tended to be neglected because they are harder to work with and to get, far better to increase the debt which already indebted customers owe you. Personal relationships are lost. I use the phrase Walmartization. What had been a transaction based on appreciating the needs of the client and providing in a fairly personal way something which would satisfy those needs became just, here's the product, we'll market it effectively. And of course, debt is a form of drug. It's rather easy to sell it, and we and many others sold too much of it. Now, in India particularly, of course, there's also quite a lot of local money, banking money involved. Although it did take, and I think the foreign money played a very positive role in showing local banks that microfinance was something worth investing in. Even in India, the local banks needed to be shown by the likes of yourselves that lending to poor people at their own doorstep was actually quite a good thing to do. But foreign money did a good job, but maybe foreign money should have recognized, like foreign aid in general, excuse me, those who are donors here and are looking forward to a long employment, but that foreign aid should have its day. It should do its job and go. And foreign money in microfinance in some ways is like foreign aid, and much of it is, of course, subsidized, and there are many subsidies as well. It has a job to do. It showed local institutions the way, and maybe it's time for it to go. Because foreign money has disadvantages. Of course, foreign currency risks have to be borne by somebody. Microfinance is affected by erratic global financial markets. Damien van Stauffenberg talked about this subject here in Brussels, a couple of years ago. And certainly I know from microfinance management in India and elsewhere, the things that happened to Lehman Brothers and so on in New York suddenly meant a drying up of funds. They didn't affect savers' willingness to save if the institution were taking savings, but this was a sort of shock which had nothing to do with what was happening in India or in Kenya, but suddenly meant that the funds dried up. Local investors and lenders are crowded out, as I say. It's more attractive, easier, more fun to go to New York than to go to Delhi. And particularly because subsidy, some element of the suppliant relationship is still there, dependency is perpetuated. And it's rather easy for bankers to lend money to microfinance institutions which lend money to the poor, or it seems to be easy. And this tends, I don't want to perhaps insult you by suggesting that those of you who are investing or lending money to MFIs are taking the easy way out, but there are far more necessary, far more urgent needs, which relate very often to finance, things such as health, education, and so on, which tend to be neglected because micro-debt is so easy to finance, pushing out the money. An interesting example, I referred earlier to the banking arm of Basics. It's called KBS Lab, Krishna Bharati's, and never mind what, bank versus the NBFC, non-bank finance company. And as I say, this gave an interesting comparative experiment because in 3 districts, partly Andhra Pradesh, partly Karnataka, we got a banking license. We were allowed to take savings. The remainder of the institution couldn't get banking license because there was some, just bureaucracy in the central bank. And so one could plot the parallel development of the banking operation, which was allowed to take savings and very aggressively tried to do so, and the pure client indebting organization in the rest of the country. And both serving very similar clients in Andhra Pradesh and in other states as well. When the Andhra Pradesh crisis came, and I don't know, I suppose those of you who know something about microfinance are aware of this. This was in October last year, when there was a year ago, when a whole variety of factors caused a kind of freeze up of microfinance repayments in Andhra Pradesh. Recoveries by the non-bank finance company, member of the Basics group in Andhra Pradesh, dropped to actually rather lower than they had been at sort of classic microfinance level, around 98%. They dropped to around 40%. Whereas the KBS Bank, which was operating under the known to be part of the Basics group, operating under a similar label and brand with some of the same staff interchange and so on, recoveries dropped too, but only by a rather small margin. They've now more or less recovered, which I think is a very interesting experiment in what the impact of savings can be on the people's attitudes to the bank, because the kind of loans which were being recovered were very similar, same kind of product as the NBFC was offering in the other district just across the road. I think those results demonstrate very clearly the advantages of having a 2-wheel bicycle, savings and credit, as opposed to a 1-wheel bicycle, which is what microcredit is. And in spite of the fact that microcredit was rechristened microfinance a few years ago, it still mainly is microcredit. Now, donors, as I said earlier, don't like stopping. They like going on. I think donors have done a rather good job in getting microfinance up and running. I remember the first time I met Muhammad Yunus was in 1985 or 86 or something. I was with the Ford Foundation in Bangladesh, and there they were providing some modest assistance to him and various other organizations in Bangladesh, helping them to get going. And that was a very valuable service. The original idea was Yunus's, of course, but it was fostered and encouraged by the Ford Foundation and other small but very creative donors. And similarly, in Africa and other parts of the world, which are less developed in terms of their microfinance, donors still are playing a very valuable catalytic initiating role. But for major microfinance institutions, in India particularly, and I think in other countries too, the job has been done. There's no need for donors anymore to play any part. I would suggest that donors should leave it alone. If donors have departments which are devoted to microfinance, which perhaps they shouldn't, given the urgency or greater urgency of so many other things, let them focus on promoting, in a sense, the demise of their own funds flows by promoting and encouraging institutions to become banks, to get banking licenses, and to mobilize local savings. Not because that's easier, as I said, because that's what clients need. And this is, I suppose, an appropriate thing to say in this institution, although rather unrealistic in most banking institutions, to re-promoting community-owned and financed banking, cooperative banking. In many countries, I remember it first happened to me in India, in Kenya, in 1972, where I was almost thrown out of a meeting in a small hut in a village near Machakos for mentioning the word cooperative. The conversation was in Swahili, not in English, but I didn't know the Swahili for cooperative, but it was a dirty word already, because cooperatives were government-imposed things which took your money. And the word cooperative is still a dirty word in India today, largely because of what government and in some cases donors have done by forcing people to cooperate, bribing, in a sense, people to cooperate. But still, I would suggest, and I think probably in this room, in this institution, this is a more acceptable view perhaps than it is in many other places, that community-owned cooperative banking on the Raiffeisen model is still, I would have suggested, the best and most appropriate and suitable way for financial intermediation to begin in poor communities. But, as I said yesterday, we've perhaps already gone too far. I was lost when I was driving around in the Republic of Ireland a few years ago, and I stopped and asked the way, and a nice old gentleman, he was a priest actually, he looked at me for something. I said, "What's the way to Galway?" He said, "You know, you shouldn't have started from here." Which wasn't a very useful comment, and then he did tell me the way. But in some ways, perhaps donors and others shouldn't have started promoting microfinance the way they did, as something which was built on foreign money. But given that that's been done, in order to perhaps repair the damage, to localize what has sadly become a bit of an international industry, and to protect existing investments, because what's happened in Andhra Pradesh, which has caused substantial losses for foreign investors as well as for local banks and others. So it's good business as well as it's doing well, or protecting yourselves from doing badly as well as doing good. I think that there are certain steps that donors and others should take, and investors. First of all, to stop lending to debt or investing, taking shares in bigger microfinance institutions. There are probably a dozen in India where I would say, go away, let them alone, leave them to local financial institutions. And in other countries there are smaller numbers, smaller institutions, but still the donors have done their job. And in order to provide an exit for foreign finance, then assistance can be provided to microfinance institutions to help them to knock on the door of local banks and to refinance their existing foreign debt with local money. It has been done. It's kind of against the interest of a lender to encourage his competitor to take over his business, but I would suggest in microfinance that's better than foreign money. Promote local share ownership by getting rid of existing investments, equity investments, and selling to local investors. And certainly in India and in other countries, there's plenty of money around, which is perhaps not looking for local investments, perhaps not looking as much as it used to for investments or whatever in Switzerland and whatever, but which it's very difficult to persuade such people to invest locally, but surely that's the kind of thing donors should be doing. To encourage local employee share ownership plans and, of course, initial public offerings, so that instead of the IPO taking place in New York or in London, or dare I say in Brussels, it should take place in Nairobi or in Kuala Lumpur or in Delhi, or Bombay it would be. And I know that this institution is in part, and it was been explained to me earlier in a rather complicated way, it's in part of a demutualization process, and of course the British financial sector is a victim of in part of the demutualization of our building societies, but it's possible to remutualize. And very difficult, maybe costs money, but this seems to me it's a difficult kind of thing that a donor organization should do in order to try to get back to the basics, from where financial intermediation should have started. It's easy for me to stand here and make these comments, but impact investment is, I think in Luxembourg, it was mentioned yesterday as the kind of new flavor of the month. Well, let's hope it's a flavor of longer than a month. But microfinance is easy. I've likened it to selling overpriced dirty water to desperately thirsty people. And that's not a very difficult thing to do. And I would suggest that foreign institutions, what they've got is money, but they should have expertise. And if they don't have expertise as well as money, they should keep their money at home. And microfinance is now another asset class. It's not a particularly warm glow, a do well and do good form of asset class. It's a form of asset. It's like Walmart. I guess Walmart has done more good than microfinance in providing cheap products and employing people at low wages to make them. But Mr. Sam Walton didn't get into Walmart to alleviate poverty. I suggest microfinance in most places is more like Walmart than the original dream of Muhammad Yunus. Doesn't mean to say it's not something you shouldn't be invested in. I would suggest it should be local investment, but it's not about donors anymore. But there are so many far more urgent needs and far more difficult things to do. Again, this is mainly affected by my work and my experiences in India. But things like primary schooling, like primary health care, like housing, like environmental green investments, whether it be the level of local solar lanterns or communities and whatever, far, far more difficult, requiring very smart subsidies, not costing as much money. But surely these are the areas in which the great, not only sums of money, but far more important, great skills, which I think we do have in our financial institutions, should be invested. It's interesting that when I think of my many friends in India who are working in microfinance, many of them are now getting out of it and are getting involved in areas of this kind. Ingenious financial arrangements whereby slum dwellers can come together and take the value that's inherent in their settlers' rights and build decent houses. Very complicated long-term financial instruments, not micro at all. Far more difficult than pushing out debt, but infinitely more needed. Promoting the construction and the initial operations of local primary schools, which can then be taken over by government, which is so far failing to do what it should do in India. Healthcare. A friend of mine is setting up a telephone-based, mobile phone-based healthcare operation in India. Very risky, very difficult, but surely far more necessary and valuable than just pouring out, putting more and more people into more and more debt, environment and so on. So there's an enormous agenda out there. A more difficult agenda, perhaps using more skill and less money. But please may I make a plea for that to be the focus of our future activities. Thank you very much.
My name is Anthony Koning. I work for CGAP, and I want to thank you for your presentations, your provocative statements that I think always help us to keep focused on why we're concerned about developing financial services for poor people. So very welcome your comments. I also liked your way of nuancing some of the statements in terms of where and when might certain capital and support be available or appropriate. And one question that I have is particularly when you mentioned the comment about the catalytic role that some support, be it local public funding or international public funding, can play, and knowing when the time is there to leave. And I was just wondering if you could comment on some of the characteristics of a market or an environment that tell us when is the right time to go.
A very good question to which I don't have an immediate answer, but being at least an emeritus professor, I suppose I should try one. Emeritus, incidentally, and I told people yesterday, it means past service of no further use. So perhaps I should shut up. I guess that, no, this isn't really a satisfactory answer. In India, certainly the situation is there, and local banks are financing, and I'm woefully ignorant about places other than India, but I think there's no need to justify paying a lot of attention to India. But giving them the chance, perhaps as Claude was saying, local banks perhaps regard this as some international CGAP, World Bank, subsidized kind of thing, and the whole image of financing microfinance is perhaps not one of profit. It's one of donor corruption, if you like, corruption with a small c, perhaps. So it's kind of backing off and making a big effort. I'm sorry, I'm not really answering your question, but I don't think I've ever seen an attempt by CGAP or anybody else to beat the drum to local banks for getting involved, to get involved, and to push us out, as it were. As I say, I don't think I've ever seen that effort being undertaken. Perhaps it is undertaken in countries which you know a lot better than I do. Even in Kenya, where I'm doing some work with an organization called Musoni, we're still dependent largely on international finance. But I hope, and it's already beginning to be evident, that local banks will get involved. I'm sorry, I'm not really answering your question, but I guess it's come in India and is probably coming in other places. Not very satisfactory, I'm afraid. Thank you.
Professor, you're quite right with everything you have said.
Oh, in that case, I've wasted my time.
But it's maybe a little bit too easy to tell that you find enough deposits in the local market and the local bank will give loans to the poor people. In reality, you see that if they find some deposits, it's very difficult to give them to the very poor. They're looking for the better clients to give these loans. Looking for? The better clients.
Yeah.
And then you don't find a good solution, I think. The goal must be that money is going to the very poor people to give them the possibilities with loans, I think, to get out of their problems. And that I doubt if, if it's reality, it's good, but in reality, I don't think it's that easy to find the combination of getting deposits and giving loans to the poorest people.
Thank you. Well, please come to Mahbubnagar in Andhra Pradesh in India, and you'll see a small bank that is doing exactly that. But just 2 points. Kind of answers to your questions. First of all, I do not believe that getting into debt is the solution for very poor people, because that's what microcredit is. That's what you are describing. And I think BRAC has been the pioneer in Bangladesh, and now it's targeting the ultra-poor program. TUP is being adopted in India and in other places. I think it's gradually being realized that dear Eunice's rhetoric about putting poverty in the museum, reaching the very poorest, this is not true, and very poor people do not need to borrow money. They need lots of other things in terms of confidence, in terms of employment, in terms of savings or ability to save. And BRAC finds, for instance, they've done it now with several hundreds of thousands of people successfully, that if you put people through a program of work, even food for work, some small forced savings, tiny forced savings, after 2 years, around 85% of them reach the stage when they're eligible for microfinance. I remember I was talking to a bunch of very poor women in Bangladesh, in a village in the north, and I said, why are you banking with, there was a Grameen Bank was over there, and one of the other banks was just a microfinance. Oh, no, they talked about Grameen Bank rather as I would talk about Goldman Sachs high net worth bankers place or something, individuals. So first of all, the very poorest people don't need microfinance, don't need microdebt. They need a more expensive, a loss-making, a heavily subsidized activity, one in which insufficient investment and attention is being paid. But secondly, I agree that local banks have traditionally been good at sucking savings from poor communities, because, as I say, poor people need to save more than they need to borrow, not very good at lending them back, because it is very difficult to make good loans in places which are very poor. But KBS Lab in India is demonstrating that it can be done, and a small but increasing number of banks or microfinance institutions which have become banks are demonstrating that it is possible to finance the whole of a loan portfolio, not for the very poorest, but for the poorest, the economically active poor, as the phrase goes, from the savings of the same community. Poor people save more than we do as a proportion of their poor incomes. They have to. So savings are there, as the existing, very often foreign banks, British banks or French banks, have proved for hundreds of years that savings can be mobilized in poor places. What's more difficult is to make good loans in those places, but microfinance has shown us how to do that.
Professor Harper, first of all, thank you for your intervention. As for me, I work for an investment management company, so basically if everything happens as you said, I'm going to lose my job. So just
you just have to use your brains more than just your money.
Regardless, anyway, what I would like to say that I really appreciate your intervention, but maybe what you're saying is not valid in all cases. For example, I work for sub-Saharan African investments. And in this case, in certain countries like Ghana and Nigeria, you do notice that local banks, for one, would not lend to microfinance institutions. And if they do, they lend at higher rates than we do as foreign investors. So there's still a market gap to fill. And my question is, don't you think that in some cases, in some markets that are less sophisticated, in Africa specifically, microfinance investors have still a significant role to play in filling this funding void, because local banks don't lend and savings are very hard to mobilize, but also to provide additional services such as technical assistance and best practices to the sector, so that in the end, in a few years, we might become useless, but for the moment, we are still very useful?
Yes, we might become useless, and of course I'm old, so I'm useless, but I think that's the missing link. I think what's happened is that this, shall we say, primary school stage that you've described, providing capacity building and so on, subsidies, fair enough, where what that ought to have moved into is handing over to local banks, persuading, as I was saying earlier, training, whatever, sensitizing local banks to this funding opportunity. What has happened instead is that it's been handed over to green, MIV, or just straight for-profit investors, foreign investors. So the kinds of activities you suggest are indeed necessary by, sadly perhaps, foreign institutions in some cases, but they should try to hand over to local sources of finance rather than to international sources, I would suggest. I don't know if that's a satisfactory answer, but with perhaps guarantees and so on, as Claude was referring to, I think, as an interim measure in order to phase out of the business of direct financing.
My name is Bart de Bruin and I'm from Terrafina. I have one question of understanding that I didn't understand well in your argumentation. What's the reason you see why the cooperative mutualist model is the best model to promote for microfinance, is the first one. And then secondly, in the whole debate for local or international money, I'm certainly not that very sure if we need to make this distinction. And if not, the best offer or the best condition is the best way of finance if you need to go for finance, external finance. Of course, I agree with you that there is a lot to do on saving and saving mobilization, but then the whole comparison between providers, I think everyone can see what's the best offer and take what's the best offer, if it's local or international. I don't see very much in the debate to separate this. Thank you.
Yeah. First of all, mutual cooperative versus straight commercial banking. I think look at history and look at the overall financial performance of the genuine small local cooperative banks, which are still very strong in Germany, in Scandinavia and so on. Look at what's happened in the last 3 or 4 years. I think there's no need to look any further for the argument that the mutual, still general cooperative type banking, which is exemplified in large scale and not very many others by Rabo, I suppose, is a healthier form of banking. And I speak very much from the Anglo-Saxon perspective when I look with embarrassment at the wreckage of our own financial sector, as opposed to the relative health of retail banking, which is such of it as has not been, as it were, polluted, in places like Germany, Scandinavia, and so on. So I think recent history in the West, the rich countries, demonstrates that local mutually owned cooperatives, of which I believe form some part of this organization, are the best source of financial services for perhaps everybody and certainly for poor people. I believe in local management. I believe national management is better than being beholden to foreigners. I mean, these are broad principles. And as I say, when I look at the wreckage of British financial sector, where we have virtually no cooperative banking, then I would say that recent experience demonstrates that this is the best way for it to be. And as far as foreign money versus local money, get the best offer, the trouble is that I learned Latin a long time ago. I learned that emeritus doesn't mean very much, but timeo denaus cum dona ferentes. I am frightened of the Greeks, particularly when they come bearing gifts. And foreign money generally has gifts of some kind, even if it's only executive class air tickets to Washington. Local money is more likely, or shall we say less likely, to be polluted by some kinds of dependency creating, whatever it might be, relationships. And given that we're talking about small institutions, relatively small amounts of money, I would have thought that the impact on the development, on financial deepening in poor places with underdeveloped financial sectors of getting into finance for microfinance institutions, whether they're cooperative owned or locally owned, is one that would be an important part of building the local financial sector rather than going abroad to get the money. It's not a wholly satisfactory answer. We can discuss it more later if necessary. Thank you.
Ladies and gentlemen, members of the BRS organization, thank you for inviting me to your House of Finance to bring a closing remark at this year's Microfinance Lunch Break. Involved in risk affairs at Belgian and European level, by doing so I'm not involved on a daily basis in microfinance, but nevertheless when listening to the professor and also while preparing for today and especially focusing on what's happening in India, I was particularly struck by the degree of parallelism that seems to be drawn, or that we can draw between microfinance and traditional Western banking. The global financial crisis of 2008, be it subprime, solvency, or liquidity crisis, you name it, and the ongoing sovereign debt crisis may well be qualified as existential crisis. Remember the doubts about the raison d'être of the too big to fail banks, doubts about the US or continental-based business models, also doubts about political institutions and their instruments such as the euro or their monetary and fiscal policies. there's a lot of doubt. And as a consequence, remedies are sought, not in the least, through a very burdensome regulatory framework, to restore the financial stability and resilience of the banking industry, and by doing so also aiming at restoring confidence within financial markets and with the customers. People reflect on the fundamentals of financing or banking in general nowadays, a lot. And some political groupings are very vocal on a more sustainable financial activity and the so-called new ways of thinking such as Islamic banking do pop up. It's in this context that I like to draw some comparison. It seems to me that today these are difficult times for microfinance. I said already I was focusing on India, but I'm told by the professor it's a rather general situation. So allow me this very high-level degree of analysis. A few studies have cast some doubt on the benefits of lending small amounts of money to very poor people. Now, there's something I do not understand. I thought this was the basic idea. There is also the very known factor of greed that seems to be filtered in. Microfinance seems to be big business. And this has caused an important psychological and political impact. There is, as a consequence, the introduction of new legislation restricting industry following complaints about high interest rates and perhaps also forms of corruption. There is the concentration risk. Too much microfinance projects limited within a selective club of players. What about competition? And then, as the professor mentioned, funding seems to be nowadays the biggest problem. Challenges ahead, I would say, but existential ones, it seems to me. You mentioned how to repair the damage, and thank you for that insight. I think there is also a broader debate on the profit dimension within microfinance. You mentioned financing, but also savings, and to be honest, I do not understand how people living on $2 a day can save after all. There is also the confusion about the future of microfinance. What about the social mission to help alleviate poverty? It seems to be business above all. I mentioned the new regulatory framework. Well, perhaps here I can make a little plea towards proportionality. As it is the case within the new Western regulatory framework, there seems to be a tendency towards one size fits all. Perhaps we should take into consideration the specificities of the different players, also in microfinance, and there you have the profit-based and the non-profit-based ones. And finally, I think it's all about confidence. Within Febelfin, my organization, we have a strategic program that is built around especially restoring the conference, and therefore we have set up a number of platforms. Platforms to discuss and platforms to create some empathy. The professor mentioned that there is a degree of expertise required, and he invited you not only to use your money but also your brains, and therefore I think these platforms can help us to understand what is really needed by those we address ourselves to. Finally, making a link with the other financial crisis we live every day, I think it's about going back to basics, going back to the fundamentals, and this without jeopardizing innovation, because innovation can also be can also contain positive developments. This this I would like to say to you. I understand from the organization BRS that next year, around February, another microfinance lunch break will be organized around the theme of, and sorry for the dirty word, Professor, cooperation. And it will be led by Mr. Marc Laby. I thank you very much.